A lot of people are talking about the pullback in the stock market, which I talk a lot about as well, and I have some comments coming out in the near future on a couple of videos on what I think could happen in the stock market as well. But this video, I want to warn about real estate. This is just my opinion, so disclaimer, just a YouTuber, not a financial advisor, but I think the real estate market is due for a major pullback, particularly because of what the Fed is doing and what they're saying they're going to do. Now, what they say they're going to do and what they actually do is up in the air. So we're going to talk about that in this video as well. If you like the video, if it brings you some value, would really appreciate it if you smash the like button because it helps the video get out there into the algorithm. And I'm really trying to expand the audience here. So if you would do that, would really appreciate it if you took that second to turn it from gray to blue and hit that like button. And also, if you want more of this type of content, please do click that subscribe right there. There should be a little subscribe square. If you click subscribe and then the bell afterwards, you'll be notified of all future videos, including the videos that I'm about to drop on the stock market in addition to this one on real estate. So let's talk about real estate. In the past, we have gone through hyperinflation, and this was particularly from 1979 to 1983. This is when Paul Volcker had to take control and basically raise the rates dramatically. And I'm going to go over that in detail in this video on the charts over here. And this did a number on the real estate market back then and caused a major recession. See, what the Fed is stuck in a hard place about is basically if they raise rates, the stock market and real estate will plummet. And they're saying they're going to raise rates, but here's the scary part, is if they raise it by the measly amount that they say, which is already affecting the stock market pretty heavy lately, and they haven't even done anything yet, keep that in mind. The Fed has done nothing. They're still at 0%. Interest rates are still zero. They haven't changed it yet. And also, they haven't finished tapering yet. So when they finish tapering, that's when they say they're going to raise rates, and they're going to raise it by a measly 0.25% or something along those lines until it reaches 0.9% by the end of the year, which is nothing. And I'm going to prove why it's nothing in this video as well, and it's not going to do any damage to actually help the inflation that we're in right now. So let me go over to this chart here on the right, and I will make some sense of what I'm talking about on why I think I would be very nervous personally if I was in real estate right now. In the near term, you're enjoying these low 3% rates, right? You're getting these cheap loans from the bank because the bank is getting a cheap loan from the Fed. If the Fed federal fund rate is down at 0% and they're giving away money for free, well, then the bank is going to make a slimmer margin on that capital and give that money away much more easy at a low interest rate to an investor. And that's why these real estate developers and people in real estate are making a lot of money throughout this entire time. But now inflation has grown out of control. And let's get over to these other charts here and I'll show you exactly what I'm talking about. So if we go over here, this is actually with the stock market, just real quick. Stock market has had a pretty serious little pullback. Even today, another 400 down on the NASDAQ, another 450 down on the Dow Jones. S&P is down another 84 today. So people in the stock market, I noticed the stock market channels on YouTube they went from kind of laughing it off a little bit to getting a little bit more nervous as of lately. I have some comments on the stock market, particularly with what the stock market is denominated in, but we're going to talk about real estate in this video. If you want to see the stock market video, please do click that subscribe. We'd love to have you a subscriber on the channel. But let's talk about inflation real quick. So the last time, and I like to bring up history because if we study history, history tends to repeat itself. And there's always signs and signals there because we have gone through something like this. And this is back in the 70s when we had hyperinflation in the 70s and stagflation. We went from, this is a key thing here. It's not just that it got to, on the yearly inflation, that it got to 13%. It's actually got a lot higher than that. It got to 14.8% at one point in one of these individual months in 1980. I believe it was March of 1980. It got to its all-time high inflation of 14.8% on one of the months. But this is the yearly chart. But look at the year from if you go from 1977, you're talking 4.7%. Then you go to 1978, 9.2%. And then from 1978 to 1979, from 9% to 3.29%. So not even a double in inflation from 1978 to 1979, and then they start They raised rates. At one point, Paul Volcker raised rates to 20%. You heard me right, and I'm going to prove it in the next chart here. He raised it to 20% to stop this. So this jump from 9% to 13% scared Paul Volcker so much that he said, okay, we got to raise rates to 20%. We got to stop this inflation. It's going to get out of control here. And what is our Fed doing? Our Fed, so it didn't even go 1x. So it didn't, if it multiplied by 2, it would go from 9 to 18%. It never reached the 18%. You got to 13.29%. But this is back with a different CPI. They used to do an actual CPI that mattered back then, where they gave real data. Now the CPI is handpicked. But still, even with the hand-picked things that they measure with our current CPI, it went from 1.36% in 2020 to a dramatic 7%. So it's not just that it's at 7% with a kind of faulty CPI, in my personal opinion, but also the fact that it jumped from 1.36 to 7%. You're talking about multiples. Not just, it didn't even get a 1x back in the last time we were in hyperinflation. It didn't even go, from multiplying from 9 2 times over, it didn't even double. So here, we did, what is that, about a 600% gain? Roughly a 600% gain, or somewhere in that range, 500-600%. That's intense. For a year over year, that is ridiculously scary. And so if this, not even a double, scared Paul Volcker enough to raise the federal fund rate to 20% at one point to stop it, our Fed is doing a measly 0.9% to stop this kind of rapid inflation. In my opinion, we're in stagflation right now. We're in a hyperinflation situation. If you're going up over 500%, over 5x year over year, that's crazy. I have to double check my math, but that's a crazy multiple right there. Now let's go to the federal fund rate. So this proves what I'm talking about. You got to remember, the federal fund rate is what the Fed is giving money to the banks. So you're talking Fed to bank. Commercial bank. Then commercial bank goes and gives money to individual investors in real estate. So Fed, commercial, individual investors. Now, if you're like Goldman or one of these, you're BlackRock, you snuck in and you got that 0% money directly from the Fed. That's what I've been told, at least. So they've figured a way to finagle a situation there where they can get money for even cheaper than the average retail investor, which I think is so flawed and so wrong. Because you're seeing these big banks gobbling up real estate, who are then going to be renting the real estate out to you and I, which is ridiculous. It should be individual investors and helping the American economy, not these individual banks that are taking advantage of the system. But I digress. Let's talk about the federal fund rate. So the federal fund rate, as you can see right now, is down at 0%. They've been giving away money for free. That is why the 30-year mortgages are so cheap right now. You look at the 30-year mortgages, and they're actually starting to go back up a little bit. So right now, I've been enjoying this 3%. If you're in real estate, you're enjoying these low rates, and this is what the bank is giving money for a 30-year loan to the individual investors. So they're getting money at 3.5%. Now the banks are getting money for free. This is pretty dramatic, because if they want to stop inflation like they did in the early 80s, like Paul Volcker did, they raised it at one point up to over 20%. As you can see right here. This is what they did to stop inflation last time. Inflation was getting out of control from the 70s, went from 6%, 5%, 4%, got out of control, and then they had to raise these rates as inflation was getting out of control. At one point to nearly 20 or over 20% at one point. That was the peak inflation. But you got to realize that when they raised these rates back then to 20%, that means the prime rates, which is what affects the loans for the individual investor, were up higher than that, which means the prime rates were at 21.5%. I believe it was June of 1981 where the prime rates had reached 21.5%, which means if you were getting a loan from the bank, you had to pay 21.5% in interest. Obviously, that would dramatically affect the current real estate bubble that we're in right now. So this just shows you how little the Fed is really doing today. So this is what the Fed did back then to stop it, and it stopped it. They were able to get inflation down to 3%. I believe in 1983 it got down. And so this is basically the Fed fund rate, not the inflation rate, but they're correlated. So the Fed fund rate goes up super high to stop the inflation. Inflation ends up stopping, so they were able to lower the rate again. They keep lowering the rate, until finally now it's at zero. So the stock market gets artificially propped up by this because there's just money for free for the banks. And then also the real estate market gets dramatically affected by this because the money is so cheap. And that's what we've seen here. The money got very cheap to get from the bank. But back when you study the chart, and I'm just the crazy individual that actually wants to study the charts here, this is real information. When you look at when they did that, you saw 30 years at 18.44% in 1981. So what would happen to the real estate market today if you had an interest rate at 18.44% for a 30-year loan? This is for the 30-year fixed mortgage here. Yeah, that would change things if you went from a measly 3.56% back to an 18.36%. So what does all of this mean? What all of this means is that if they keep up what they're saying they're keeping up, which is stopping the QE, stopping the money printing, which means tapering, and then they're saying they're going to raise rates. Now, this can go one of two ways, really. They either do what they say they're going to do, and that proves to not be enough. The stock market still plummets, which it already is doing, and it proves to not be enough. Then they have a choice. They either go back to QE and kick the can down the road, which would increase the money supply and dilute the dollar even more than it already has been diluted. Over $13 trillion printed in the last 2 years, which that could happen. Now, if that does happen, this might not hit real estate as hard as I think it will. But if they do what the right thing is, which would be, wait, 0.9% isn't enough. Inflation is out of control. Inflation could get from 7% to overnight. If it just, think about it, it went from 1 point some odd percent to 7%. What would happen if it kept up that multiple and compounded year over year? That's another thing people don't talk about. If it keeps up and holds even at 7%, that 7% compounds. And compound interest is a good thing when it's working for you, but when it's working against you, you're stuck in a very hard place. So inflation is getting out of control and growing dramatically. Now, what they would have to do is what Paul Volcker did. They would have to raise rates not to a measly 0.9%, but they would have to raise rates to 15, 20% to stop this. And even that would be hard to stop. It still might not do as much that you would think. So if they end up doing that, real estate would immediately panic overnight. And they could do that on one of their. We could see a report come out where inflation is dramatically out of control. They admit we're in stagflation finally. They admitted it's not transitory already, which they had been saying for a long time. So next they could admit, hey, it actually is out of control. Hey, we are in a kind of a stagflation right now. Hey, we are in hyperinflation. If they do that and they say, hey, 0.9% isn't going to be enough to stop this. Not only do we have to taper, but we also have to raise rates like we did back in the 80s. Like Paul Volcker did to stop it in the 80s and raise it back up to 20% again. Now, what happened when they did that? There was panic. There was recession. Stock market collapses. Real estate collapses because the money isn't so easy to get. It doesn't become so diluted. Like people would be much more conservative with their investments in real estate if the interest rate to get that loan was not 3%, but was 21.5%, like it was back in 1981. That would be very scary. So again, people get over leveraged when you give them money for cheap. And they have been giving money away for very cheap for a very long time. It goes one of two ways. The Fed either admits that this is not enough, or they go back to their old ways and kick the can down the road. Now, let me know in the comments down below what you think happens. It could go either way. But one thing is certain, regardless which way it goes, in my personal opinion at least, inflation can't be stopped. They can't stop it with unlimited QE. That's just going to cause more inflation like they already caused. And then they can't stop it with a measly 0.9%. That's not going to do anything either. So they have to raise it like Paul Volcker did back to over 20%. Back in the 80s, or they have to bluff and keep kicking the can down the road. Again, let me know what you think of this in a comment down below. Would really appreciate your input on this. And again, if you have not liked these videos, would really appreciate it if you smash that like button. You take a second to turn that like button from gray to blue. Really means a lot to me and helps get these videos out to more people. I spend a lot of time doing this research and I got nothing to sell you. I just want to basically get this information out there. And if you could be so kind to subscribe to the channel, would really appreciate you clicking that red subscribe right there. If you click the subscribe and the bell afterwards, you'll be notified of all future videos. We do live streams every Friday. We do every Monday. I do a Monday motivation video. I try to do things on a consistent basis. And I've also been posting a lot on the social medias as well. So if you're not following me on Instagram, please do follow me on Instagram at Rob Soltan on Instagram. I give a lot of insights of what I'm buying right now, and also when I drop a new video, I show it in the story over there as well, so you get a notification there as well. If you would be so kind to follow me on Instagram, again, at Rob Soltan on Instagram, and on Twitter as well. There should be all the info in the description down there as well. Thank you so much for watching. See you at the next video.